Okay, so I'm going to walk you through several Chapter 9 textbook illustrations on budgeting. Okay, so this is going to be exercise 9-3. We're going to start you off with the sales budget. And this is, remember, this is the first thing you start with the master budget is you start with sales. So in 9-3, this is going to be for Duke Sports. They offer two types of physical exams. They've got the basic, which is right here, the basic, and they call the extended. They give you the charge, which is basically the selling price for the basic physical is 105. The selling price for an extended physical is 160. They tell you that they're going to perform 240 basic and 170 extended physicals in July, 250 basic, 230 extended in August, 75 basic, 90 extended in September. And then what they want you to do is for each of these months, and then to summarize it for the quarter, is to put together the sales budget. On the next slide, we'll walk you through the numbers. Okay, so here's your sales budget. Notice again, all these numbers were given in the problem. This first category is your basic physicals. Notice they gave you the 240, the 250, the 75. Here's the selling price, 105. You just multiply those. You would then get the sales revenue, and you would do that for each of the months. Then you go down here. This is going to be the extended physicals. And again, they gave you these numbers within the problem. You just have to multiply it by the charge or the sales price of the physical. That's going to give you the revenue. You do that again for each month. And then if you would just a total, you take 25.2 plus 27.2. Here at the bottom, that would be for the month of July. You can then do that for August, for September, and then you can total it for the quarter. This is called your sales budget. Okay, so the next budget is called your production budget, and typically your production budget is the second schedule you put together. Once you've got your sales, then the budget or your production is based on sales. So the starting point for this budget will be your sales, which they're going to give you all your budgeted sales in units. This is bicycles right there. And they're going to give you an inventory formula. They tell you that, for example, on March 31st, they had 220 bikes. Here's their policy. This is their inventory policy, which is a 30% stock ratio. They want that to be 30% of the next month's sales. And then again, they want you to do a production budget for the months of April, May, and June. We'll use these numbers. And notice the starting point will be the bikes. You'll see these on the next slide when we look at the schedule. So again, you'll notice this is in a horizontal format. Here's April, May, and June. They gave you this top row of unit sales. Here's their desired inventory number, which is 30% of the next month's sales. So for example, if you are in the month of April, you would take 30% of May's. That's going to give you 354. You add that to 1,000. That gives you 1,354. The beginning inventory, they gave this one to you. You subtract that, so that would be your required production for the month of April. If you're in the month of May, again, you would take 30% of the 1,320. That gives you desired ending for May of 396. You add that to your unit sales. You get total needed. Your beginning inventory, remember, would be the 30% of the 1180, which is again 354. You subtract that, and that would be your required production for the month of May. So then when you go to June, again, you have to go back to the previous slide. They did give this to you. They gave you the July sales. You would basically take the 30%. Again, that number is not on this slide, but it's on the previous slide. You would take the 30% of July sales. That would give you this ending inventory for June. And then, of course, you would subtract out the beginning inventory, which is the 30% of June sales, to give you your units to produce for the month of June. Now, be careful on this summary column. This is where some people get a little confused. Remember, this is at the end of the quarter, and we're dealing with finished goods inventory. So at the end of the quarter, your ending inventory will simply be the same number that whatever it was at June. So you're just going to drag that number over. And remember, your beginning inventory would have been at the beginning of the quarter, so they're going to pull over that 220. Once you subtract that, that's going to be your summary for the entire quarter, and you should be able to proof it. If you were to take 1134 plus 1222 plus 1284, that should prove that it should be 3,640 as a summary for the quarter. Okay, so the next budget we're going to be looking at is the direct materials budget. This is going to be S9-5, and in this problem, it's a company that makes bread, and we're looking at the ingredient of flour. And one of the keys here in the problem is the conversion of how much flour goes into each loaf of bread. And that factor is going to be 1/2 pound. We're going to need that to do our materials budget. We're also going to need how much it costs, because that'll be factored into the financial aspect of it. And then, of course, down here below, they're going to give you the inventory requirement, which right here is going to be 10% of the following month's flour needs. So we're going to need that 10%. They go ahead and they gave you the 100 pounds of flour on hand. And of course, remember the starting point for the materials budget in this case will be production. So these numbers right here, they've already given you the budgeted production. So this is going to be our starting point to determine how much raw material of flour we're going to need. So on the next slide, we're going to put all these numbers into the schedule. Okay, so as you can see in this schedule, again, notice the very top part of the schedule, you start with your production units. Those are already given for you for each of the months. And then notice it was that 1/2 pound of flour. They're presenting this as 0.5, that means a half. You're going to multiply that by your production. You do that for each month. Once you do that, that gives you what they say, that's the quantity needed for each production. So if we're in July, we need 730. And then here we get to that desired ending inventory, which is, it says 10% of the following month's production. So you would basically take 10% of the 960. That would be the August number once you've converted it. You'd get ending inventory of 96. You're going to add that. That's the total needs. They already told you that the beginning inventory was 100, so you subtract out that. So the amount you're going to need to purchase is right there at 726 at $2 per pound. Your total purchases in terms of cost for the month of July will be 1,452. And you simply just follow this along for each month. If you're in the month of August, again, to get this ending inventory, you're going to be taking the 10% of the 880. Now remember, a common mistake people make with this budget is they forget to do this conversion factor first. You always have to do that first before you do the inventory requirement. So just remember that. But once we've done that, that's where they're getting this 88. Again, same format, you add that. You then subtract out the beginning inventory, which was again the 10% of the 960. And then that's going to give you 952 times $2 per pound. That will be your total purchases for the month of August. Now then when you go to September, of course, they would have needed to have given you October's production, which they did. So if you go back to the previous slide, they've got that. You'll need to take that times 0.5, and then whatever you get there, you're going to multiply that by 10%, and that's where they're going to get that 74. But it's the same flow, it's the same formula. You should be able to get September's, and then of course you should be able to summarize it for the quarter. This is your direct materials budget. Okay, so the next budget we want to look at is the direct labor budget. This is S9-6. Same thing, the starting point is going to be with production. They went ahead and they gave you the production numbers right here. We need to know how to convert production units into how many hours of labor. They tell you it's basically 6 hours to make a unit. They pay their workers $16 per hour on average. We're going to do this budget for January, February, March, and then we're going to summarize it for the quarter. Okay, so here's your schedule. Notice again, you start with your production units. These are all given to you in that top row. You need to convert it. They told you it was 6 hours to make a unit, so you multiply each of the production units by 6. That tells you total hours needed for each month. You then multiply that by the rate of labor, which is $16 per hour. That's going to be your payroll right here for January, for February, for March, and then you just have to add these up. That's going to be the total. To summarize it, that'll give you the total for the quarter. Okay, now the next one we're going to look at is your manufacturing overhead budget. And typically when you see your overhead budget, they always like to break this one in two parts where they show you variable overhead and then the fixed overhead. In this particular one, it looks like your variable overhead is going to be based on direct labor, so that's why they're giving you these numbers right here. If it was any other unit that your variable costs were based on, they would give you it. Like for example, machine hours is a popular one that they like to give you. And then they tell you down here what their variable rate is. It's $1.60 per direct labor hour. They also tell you that your fixed overhead is $3,000 per month, and then they want you to do your budgeted overhead for the months of April, May, June, and then again to summarize it for the quarter. Okay, so you'll notice when you look at this schedule, notice the starting point. They've got two categories here. I'll just kind of try to segregate these. This first category is variable, and then this last one is basically your fixed. So think of this as two parts. You got your variable, and then you got your fixed overhead. To get the variable overhead, it's the 490 direct labor hours times that rate. So this number right here is your total variable overhead. You do that for each month. Your fixed overhead was just given at $3,000. You add those two together, that's going to give you your total overhead for April. You do the same thing for May, June, and then you just kind of add these across. That'll be the summary for the quarter. Okay, so this is going to be 9.8. We're going to look at your period cost. They call these your operating expenses. And again, this one typically they start with whatever your unit sales are. And again, they're going to break this between variable and fixed. And we'll show you this schedule on the next page, on the next slide. But again, you just have to use all the data that they've given you. They tell you that the variable operating is about $6 per unit sold. And then you just have to plug in what the fixed costs are. You got salaries, rent, and depreciation. And then we'll put together the schedule for the months of July, August, and September, and then we'll summarize it for the quarter. Okay, so you can see when you look at this schedule, notice you've got July, August, September. You start with your unit sales, which were given. They want you to do your variable and fixed, so I'm going to kind of segregate these. This is your variable expenses right there, and then everything else, I'm just going to say this is number 2. This is your fixed. So of your variable, they set it $6 per unit sold. So you're basically just taking each of these unit sales and you're multiplying that by 6. That's going to give you total variable for July. You do the same thing for August, September. And then for your fixed cost, notice all these are the same. You just have to plug them into the right appropriate column. You add them up. You would get total fixed of $10,600. You take that plus the variable. That's where they get the total operating for July. You can do the same thing for August, September, and then add them up for the quarter. But again, remember operating expenses, this is simply your selling, your general selling and admin type of budget, or think of it as your period cost. Okay, next up we're going to look at a budgeted income statement. And again, our format for this income statement will be sales minus our cost of goods sold to get gross profit. And then we're going to subtract out our operating expenses to get net income. And again, we'll show you this on the next slide. You just have to read it and look at the paragraph and see what they've given you. They tell you your expected sales of scales is 800. That's the sales price of 2350. The cost of goods sold per unit is 1400. They went ahead and gave that to you. They then go on to give you your period cost. You've got variable operating, which is 110 per unit sold. You've got your fixed, which is 7700. They give you some other types of costs. You have interest expense. They give you a tax rate. So you use all this. It's still an income statement. You'll use all this then to put together your budgeted income statement. We'll show you this again on the next slide. Okay, so again, if you look at the start, you got sales. They told you it's going to be 800 scales. Notice 2350 is the sales price. So 1,880,000 is your sales revenue. They also told you the cost was $1,400 each, so that's going to be your cost of goods sold. You just have to multiply that by what you sold. So 1,120,000, that's your cost of goods sold. You would subtract that from your sales revenue. Here's your gross profit of 760. Everything below this is all of your operating expenses. They told you that the variable part was $1.10 each. You have to multiply that by 800 units sold. That gives you 880. You then subtract out, or you add up the fixed cost. That'll be the fixed portion of your operating. So once you subtract these two, you get your operating income. Interest expense is always a separate line item on income statement, so you're just going to show that separately. You're still going to subtract it. You subtract out the 3,700, and then of course you're going to have to determine in terms of your net income, which I believe the tax rate was 40%. That's going to give you a tax of $299,088, which would then give you net income of $448,632. Okay, so the last illustration I'm going to walk you through is a cash collections budget. This is exercise 927A. Let's read this. We've got Bentfield Corp has found that 60% of its sales in any given month are credit sales. That means 40% must be cash. It says of the credit sales, they have experienced the following collection pattern. So you got 25% collected in the month of sale, 50% in the next month, and then 24% 2 months later. This 1% that's never collected, we're not going to worry about that because again, we're worried about collections, not non-collections. So anytime you ever see this stuff about something percent is never collected, you can ignore that. They go ahead and tell you of what November sales were last year. They give you December sales. They give you projected sales for the next 3 months are as follows. And then the requirements down here before, they want you to do a cash collections budget for the first quarter. So basically January, February, March. We'll show you this in the next slide. Before I get that, just remember in any given month, you're going to have to go back 2 months if you look at this collection pattern. So for example, in the month of January, you're going to have to actually go back to November, because some of November's sales could technically still be collected in the month of January, because based on this collection policy, it says 24% are received 2 months after the sale. So the trick with these cash collections is once you look at their collection pattern, when you take any given month or quarter, most of the time you're always going to have to look backwards to see what happened in the previous months to project what's going to be collected in the current month. So again, remember the other thing about this you got to watch out for is that once they give you these sales numbers, you have to also remember that 60% of those is the credit part. So you're going to have to do another calculation before you actually do the cash collections, because these collection patterns are based on the credit, not the sale, not the cash sales. So once you take November sales of 85, you'll have to multiply that by 60%, and then you got to worry about these percents. And same with all of these. So in this collection pattern, remember, you're going to have to use this 60% first before you then get to the collection on your actual credit sales. But again, we'll show you all this on the next slide. Okay, so when you look at this cash collections, let's start again with the month of January. And I'm going to write these up just to kind of remind you. January's actual total sales were 155,000. And they told you that 40% of that was cash. So if you would multiply that by 40%, that's where they're going to get that 62,000. Of course, you do that for any month. It's always 40% of the current month's sales would be how they get the cash. So the rest of it, so in other words, so the 155, let's go back. If you were to multiply that by 60%, then that's going to give you your credit sales. And then if you follow the collection pattern, the pattern said that you collect 25% of the credit sales in the current month. You then, once you multiply by that 60%, you then take that 25% and multiply it by whatever those credit sales are. That's where they're going to get the 23,250. Okay, and then of course, if you want to just kind of write this across each month, so then you say 50% is going to then be in the next month. So you could then take 50% of this same number. That's where they're going to get the 17,250, and then the 24% 2 months later. That's how they're going to get that number for March. So again, before you get these numbers, you always have to do that 60%, convert it to the credit sales first in order to figure out what the collection pattern is. But if we're back in January, so we've got the 40% of January's is cash, that's the 62. We took 60% times 155, then multiply that by 25%. That's going to give you your collections based on those sales. That's going to be right there. Then this 50%, you actually have to go back to December's numbers. And December's was 110,000. So what you'll do is you'll take that, multiply that by 60%, and then multiply that number by 50%. That's how they're going to come up with that 33,000. So then on this 24%, you have to go back to the month of November. And November sales, just to remind you, were 85,000. You'll have to multiply again that by 60%, and then multiply that number by 24%. That's where they're going to get this number right here. You add all these up, you would get a cash collections for the month of January of 134.90. And really, you just have to watch your month. So this was January. Then when you go into February, you have to think about this. What months are you going to be looking at? You're going to be looking at the month of February. You're going to be looking at the month of January, and you're going to be looking at the month of December. You always have to go back 2 months. So again, you just have to also remember that once you go back to whatever month you're trying to convert it, you'll have to do the 60% and then whatever percent this is to get these individual numbers. If you can follow January's, you should be able to follow through and fill in the months of February and also for the months of March.